In just over 3 hours on Thursday, February 12th, the metals market erased an entire week of gains. Not a full day, not a session. 3 hours. Gold gave back what took 5 days to build. Silver fell even harder. And if you were watching the charts in real time, you saw something that does not happen in normal markets. You saw a vacuum. Price did not slide. It dropped through air. Bids disappeared. Liquidity thinned to almost nothing. And by the time the dust settled, the damage was done. Accounts that were profitable at breakfast were underwater by lunch. That is not normal volatility. That is fear with a deadline. And the deadline is this. Starting this weekend, Chinese exchanges are going dark for the Spring Festival holiday. The Shanghai Gold Exchange, the Shanghai Futures Exchange, the largest physical precious metals market on the planet, is about to go silent for days. And when a market that size goes offline, everything changes. Liquidity thins globally. Price discovery shifts to centers that are not equipped to handle the full load. Books get shallower. Moves get more nervous. And the potential for outsized volatility in either direction increases dramatically. If you own gold or silver in any form, physical, ETFs, miners, futures, or even if you are sitting on cash waiting for an entry point, the next 72 hours matter. Not because I am going to predict a price, I am not, but because I am going to show you what the structure of this market is actually telling us right now, how to read the signals that separate noise from real risk, and how to position yourself so that whatever happens next week, you are making decisions from a framework, not from fear. Stay until the end, because I am going to give you a complete checklist of 7 signals you need to monitor daily through the end of February and into March. If 4 or more of those signals deteriorate simultaneously, the probability of a squeeze or a structural disruption rises sharply. And you want to know that before it shows up in price, not after. Hello everyone, Ken AG here. If you are new to this channel, let me tell you what I do and what I do not do. I do not sell fantasy. I do not tell you silver is going to $1,000 by Friday. I do not pump. I do not panic. What I do is translate market data into practical decisions for people who actually invest their own money. And today the focus is simple. Narrative is noise. Flow and delivery are reality. Let me show you the reality. Quick disclaimer, this is educational content, not financial advice. I am not recommending any specific trade or position. Markets are volatile, risk is real, and every person needs to make their own decisions based on their own situation. Now let us get to work. Let me start with what actually happened on Thursday, because understanding the anatomy of that sell-off is essential for knowing what comes next. Fast drops like what we saw on February 12th usually come from 3 forces combining at the same time. Force 1 is deleveraging, stop losses getting triggered, margin calls getting issued, leveraged positions being involuntarily liquidated. This is mechanical selling. It has nothing to do with anyone's view on gold or silver fundamentals. It is risk management systems doing what they are programmed to do when price crosses a threshold. Force 2 is thinner liquidity. Markets do not have infinite depth at every price level. When big sellers hit the market during a period of reduced participation, there are not enough bids to absorb the flow without significant price concession. The order book has gaps, and price falls through those gaps like water through a broken floor. Force 3 is anticipatory fear, specifically, fear of an event ahead. In this case, the Chinese Spring Festival closure. Large institutional participants know that liquidity is about to thin further. They know that holding risk over a holiday window when a major exchange is offline is uncomfortable. So they reduce exposure preemptively. Not because they think the thesis is broken, because they do not want to be caught in a position they cannot manage during a low liquidity period. When those 3 forces combine, the market does not fall slowly and gracefully. It falls in a vacuum. And that vacuum is what we saw on Thursday. The key question now is what follows a vacuum drop. And there are historically 2 paths. Path A is a short technical rebound. The selling exhausts itself. The leverage longs that needed to be flushed have been flushed. Value buyers and physical demand step back in, and price recovers some or most of the drop over the following sessions. Path B is continuation. The sell-off was not just deleveraging. It was the market recognizing a structural change that justifies lower prices. In that case, the bounce is weak, and the next leg is lower. So, which path are we on? Let me show you what the data says, because I am not interested in guessing. First, look at gold. Gold is holding around $5,000. That is an extraordinary level. A level that would have been considered fantasy 3 years ago. Despite the Thursday drop, gold did not break its broader structure. The macro thesis, currency debasement, central bank accumulation, geopolitical uncertainty, de-dollarization flows, all of that remains intact. Gold is not acting like a market in structural decline. It is acting like a market that got hit by a liquidity event and is absorbing the blow. Now look at silver. Silver fell harder than gold on Thursday. That is typical. Silver always falls harder in a deleveraging event because it is a smaller, more leveraged, more speculative market. But silver is also rebounding. The rebound is messy. It is volatile. It is not clean or comfortable, but it is happening. What this creates is an interesting read on market psychology. The market has not dismantled the full macro thesis for precious metals. It has not abandoned the structural case, but it is repricing timing and short-term execution risk. There is a huge difference between those two things. When the market reprices the thesis, you see sustained selling, broken support levels, and a change in the character of buying. When the market reprices timing, you see violent shakeouts followed by recovery, which is exactly what we are watching. If gold sustains high levels while silver remains more volatile, that pattern usually indicates a narrative battle phase. On one side, you have flight to safety flows supporting gold. On the other, you have tactical liquidity stress weighing on silver. That is not a broken bull market. That is a bull market doing what bull markets do in the middle of their run. They shake, they scare, they flush, and then they resume. Now let me get to the core of why the next 2 weeks matter so much. Because this is not just about the Chinese holiday. This is about delivery structure. And delivery structure is where the real risk lives, far beneath the surface of the price chart that everyone is watching. Here is what the data is showing us right now. Registered metal in exchange warehouses, the metal that is actually available for delivery against futures contracts, has been declining. We have seen migration between categories, metal moving from registered to eligible status, which effectively removes it from the deliverable pool. We have seen net withdrawals of metal from the system. And all of this is happening while March open interest, the number of futures contracts standing for potential delivery in March, remains elevated. Let me explain what this means in practical terms, because most people hear these words and their eyes glaze over. But this is the single most important dynamic in the precious metals market right now. A futures contract is a promise to deliver metal at a specified date for a specified price. When you buy a futures contract, you are buying that promise. When the delivery date approaches, the person who sold you that promise has to either deliver the metal or buy back the contract to cancel the obligation. If there is plenty of metal in the warehouses, this process is smooth. Shorts deliver, longs receive. Everyone is happy. But when the ratio between outstanding contracts and deliverable metal gets tight, friction increases. And when friction increases in a delivery market, price becomes the adjustment mechanism. Price has to rise to incentivize shorts to find metal, or to incentivize longs to accept cash settlement instead of physical delivery. That is how futures markets work. When the plumbing is clean, price reflects sentiment and outlook. When the plumbing gets congested, price reflects urgency and stress. Let me walk you through the delivery process itself so that you never confuse it again. The short, the seller, initiates delivery intent. After declaring intent, there is a defined window to perform. The long, the buyer, who stays positioned through the delivery period, may receive an allocation. They do not get to choose the exact minute. They choose to stay in the game. If the allocated metal is short on timing, if the short cannot deliver on schedule, the short typically has to buy back contracts at higher prices to reduce their exposure. That buyback is forced buying, and forced buying into a thin market pushes price higher, which can force more shorts to cover, which pushes price higher still. This is the mechanics of a squeeze, not a conspiracy. not manipulation, just the mechanical consequence of too many promises chasing too little metal in a compressed time window. Now, here is the critical distinction that separates informed participants from the crowd. There is an enormous difference between there can be a squeeze and there will be a squeeze. Confusing those two statements is one of the most expensive mistakes in commodity markets. A squeeze is not automatic. It requires three specific conditions to exist simultaneously. Condition 1: persistently high open interest as the delivery window approaches. If longs roll their contracts forward to later months, if open interest declines in an orderly fashion, the pressure dissipates. No squeeze. Condition 2: insufficient available metal at the right time to satisfy delivery requests. If metal appears in the registered category, if warehouses restock, the constraint loosens. No squeeze. Condition 3: longs who are willing to stay positioned and not concede on price. If longs are willing to accept cash settlement or roll forward at a small premium, the pressure releases without a violent move. No squeeze. You need all three conditions present at the same time. Without all three, the market finds a normal exit. Friction exists but resolves. Price adjusts moderately and life goes on. But with all three present simultaneously, price elasticity collapses. The market runs out of easy exits, and the move accelerates in a way that can be violent, fast, and punishing for anyone on the wrong side. So, where do we stand on those three conditions as we head into this critical window? Let me give you the scenario framework I am working with. Not predictions, conditional analysis. Scenario A: the most probable outcome, orderly adjustment. In this scenario, shorts roll or close their positions gradually over the next several weeks. Some metal reappears in the registered category as holders take advantage of elevated prices. Delivery happens, but without extreme stress. Price experiences high volatility but no rupture. We get sharp moves in both directions, nervous sessions, uncomfortable drawdowns, but the system absorbs the pressure without breaking. This is how most delivery windows resolve. Most of the time, the market finds an exit valve that prevents a full squeeze. I assign this scenario a medium to high probability. Scenario B: a real short-term squeeze. In this scenario, open interest is slow to decline. Longs dig in. They are not interested in rolling forward. They are not interested in cash settlement. They want metal. Deliverable metal does not materialize in sufficient quantity because the registered pool has been shrinking for months, and warehouse operators are not seeing significant inflows, and shorts are forced into aggressive buybacks that push price sharply higher. This creates the kind of violent intraday action that makes headlines and makes social media explode. Multiple percentage point moves in a single session, gaps on the open, thin air between bid and ask, where price teleports from one level to another without trading in between. If you are positioned correctly, long with manageable size and no margin pressure, it is extraordinarily profitable. If you are positioned incorrectly, short or over-leveraged, or in illiquid instruments, it is devastating. I assign this scenario a medium probability. Not high, not low, medium. It is a real possibility that deserves respect, preparation, and a plan for how you will act if you see it unfolding in real time. Scenario C: fast relief. In this scenario, the macro backdrop shifts. Economic data surprises to the upside. The dollar strengthens meaningfully. Real interest rates rise. Risk appetite collapses globally. Or some combination of factors removes the fundamental pressure from the precious metals complex. Flow exits the sector. Open interest drops rapidly. The delivery window passes without incident. Silver gives back part of its recent gains. The thesis is not dead, but the timing is delayed. I assign this scenario a medium to low probability given current conditions, but it cannot be dismissed. The point of laying out scenarios is not to tell you which one will happen. It is to force you to think about what you will do in each case before it happens. Because if you wait until the scenario is unfolding to decide your response, you will be making decisions under maximum emotional pressure. And decisions made under maximum emotional pressure are almost always wrong. Now let me translate this into practical positioning, because this is where analysis becomes action. If you hold physical metal, you are in the most defensive position. Physical protects wealth. It has no margin calls. It has no expiration dates. It has minimal sensitivity to intraday noise. Your time horizon is measured in years, not hours. The volatility we are experiencing right now is largely irrelevant to a physical holder with a multi-year horizon. You do not need to do anything. You need to understand what is happening so that you do not panic and sell into a shakeout that resolves within days. If you hold ETFs or derivatives, you have better liquidity but higher sensitivity to short-term flow. The Thursday drop hit you harder than it hit the physical holder. The recovery will benefit you more if it continues. But you also have to manage position size, margin, and the possibility that volatility increases further during the Chinese holiday window. ETFs and derivatives are tactical tools. If you hold miners, you have the highest leverage to the metal price. But you also have the highest execution risk and the deepest drawdowns. Mining stocks fell harder than the metal on Thursday. They always do, because miners carry operating leverage, meaning their profits swing more than the underlying metal price. A 10% drop in silver can produce a 20 or 30% drop in a leveraged junior miner. That is the nature of the instrument. It is not a flaw. It is a feature that works spectacularly in both directions. The question is whether you can withstand the downside volatility to capture the upside. If the answer is no, you are oversized. Here are my 5 rules for navigating this specific phase of the market. And these are not theoretical. These are rules I follow with real capital. Rule 1. Never trade a size that destroys your sleep. If you're lying awake at night checking futures prices on your phone, your position is too large for your risk tolerance. Reduce until you can sleep. Seriously, the market will still be there tomorrow. Rule 2. Do not place obvious stop losses in liquidity hunt zones. The Thursday drop was partly driven by stop hunting. Algorithms know where the clusters of stop losses sit. They push price through those clusters to trigger forced selling, then buy the dip. If your stops are sitting at obvious round numbers or well-known support levels, they will be taken. Consider wider stops, mental stops, or options-based hedging instead. Rule 3. Separate your protection portfolio from your tactical portfolio. Your core physical position is not the same thing as your trading position. Do not manage them with the same rules. Do not let a loss in your tactical book cause you to sell your protection. They serve different purposes. Treat them differently. Rule 4. Define in advance where the thesis invalidates, where you add, and where you reduce. Write it down. Before the market opens, before you are under pressure. If silver drops to X, I do Y. If gold holds Z, I do W. Make the decisions when you are calm. Execute them mechanically when the market is chaotic. Rule 5. Review your thesis based on data, not based on a 15-minute candle. A single red candle does not invalidate a structural thesis that is supported by years of deficit data, inventory trends, and macro dynamics. A single green candle does not confirm a thesis either. Use the data. Ignore the noise. Metals markets punish ego. Now here is the checklist I promised. 7 signals to monitor daily through the end of February and into March. Write these down, track them, and use them as your decision framework. Signal 1. March open interest trajectory. Watch whether open interest in March silver and gold futures is declining in an orderly fashion or remaining stubbornly high. If it stays high as the delivery window approaches, stress potential increases. Signal 2. Registered inventory levels. Watch the daily reports from COMEX. If registered metal, the metal available for delivery continues to decline or fails to rebuild, the constraint tightens. Signal 3. Eligible to registered migration. Watch whether metal is moving between categories. If eligible metal is being converted to registered, it is a sign that supply is being made available to meet delivery demand. If the migration is going the other direction, from registered to eligible, supply is being removed from the deliverable pool. Signal 4. Net metal withdrawals from the system. Watch the total vault levels, not just the category breakdown. If metal is physically leaving the vaults, that is a hard signal of tightening. Signal 5. Physical premiums and spread behavior. Watch the premium of physical silver over the spot price. Watch the spread between spot and nearby futures. If premiums are rising and spreads are widening, the market is telling you that physical metal is becoming harder to source. Signal 6. Intraday volatility around critical dates. Watch how the market behaves during the Chinese holiday closure. Watch how it behaves when Asian trading resumes. Watch the behavior around delivery notice dates. Increased volatility around these specific dates is a symptom of structural stress, not random noise. Signal 7. Roll flow into later months. Watch whether positions are rolling from March into May or later months. Heavy rolling is a relief valve. It removes pressure from the near-term delivery window. Light rolling means positions are staying put and intending to stand for delivery. Here is the rule. If 4 or more of these 7 signals deteriorate simultaneously, squeeze risk rises sharply. Not certainly, but sharply. And the difference between being prepared for that scenario and being caught off guard by it is the difference between a profitable month and a devastating one. Now let me address the Chinese Spring Festival factor directly, because this is the timing element that makes the next 72 hours particularly sensitive. When Chinese exchanges go offline for the holiday, part of the global price discovery mechanism goes dark. China is the world's largest physical gold market. It is a massive consumer of silver for industrial applications. It is a critical node in the global precious metals infrastructure. When that node goes offline, the remaining markets, COMEX in New York, the London bullion market, the Middle Eastern hubs in Dubai and elsewhere, have to carry the full weight of price discovery with reduced participation. And they are not designed to do that alone. The global precious metals market is a 24-hour ecosystem. Remove the Asian session and you do not just lose volume, you lose the physical buyers who anchor price to real demand. You lose the arbitrageurs who keep prices aligned across exchanges. You lose the depth that absorbs shocks. Moves become more nervous. Bid-ask spreads can widen significantly, especially in silver, where liquidity is always thinner than gold. Speculative flow has outsized impact because the books are shallower, and the counterbalancing physical demand from Asia is absent. Headlines that might be absorbed easily in a fully liquid global market can trigger disproportionate reactions when half the world is on holiday. Then, when Chinese markets reopen and Asian flow returns, repositioning can be strong. Participants who were sidelined during the holiday come back and adjust to whatever happened while they were away. If price moved significantly during the closure, the adjustment can be violent. If price was stable, the return is smoother. But either way, the transition from holiday mode back to full liquidity is a period of elevated risk that deserves respect. So let me bring this together into a single summary. The Thursday sell-off was a liquidity event, not a thesis collapse. The macro case for precious metals remains intact. Gold is holding extraordinary levels. Silver is volatile, but recovering. The structure beneath the surface, delivery data, inventory trends, open interest dynamics, tells a more complex and more important story than the price chart alone. We are entering a critical window. The Chinese holiday reduces global liquidity. March delivery approaches with elevated open interest and declining registered metal. The conditions for a squeeze are present but not guaranteed, and the conditions for violent volatility in both directions are almost certain. This is not a time for conviction without process. This is not a time for ego. This is a time for checklists, for scenario planning, for disciplined position sizing, and for the kind of cold-blooded risk management that separates people who survive volatile markets from people who get carried out. Track the 7 signals. Watch the data daily. Make your decisions before the market forces them on you. And remember that in metals markets, the people who get paid are not the ones who guess the loudest. They are the ones who prepare the most. This is not about guessing tops or bottoms. It is about understanding when structure gets tight and price needs to react. And structure is getting tight, right now, in real time. Whether that tightness resolves quietly or explodes violently depends on variables that will unfold over the next 2 to 4 weeks. And you want to be watching those variables, not reacting to them after the fact. Now I want your take. Do you think we get an orderly adjustment into March or a real silver squeeze? Drop your view in the comments. I read them and I want to know what this community thinks. If this video helped you see beyond the headline, hit the like button, subscribe, and turn on notifications so you get the next update first. Because the next 2 weeks are going to be decisive, and I will be here breaking down every signal as it develops. Thank you for watching until the end. I will see you in the next one.